hand it over to you. I really appreciate you taking the time to be with us today.
Yeah, I appreciate that, Curtis. Thank you very much. And I want to thank everybody for coming out today. And Curtis, you did a great job talking about the risks in a retirement portfolio if left unaddressed when we're talking about long-term care needs. That extended care event, especially, in cases, well, it doesn't really matter whether it's single or spouses, those extended care events can just devastate any well thought out, well planned out retirement plans. And so, protecting against that, making sure that they're completely covered from any extended care event is a very wise idea. So I just wanted to talk a little bit about the market advantages of our solutions, our asset-based long-term care. So without any further ado, let's kind of get in here to the presentation today. Really wanted to talk about 5 key advantages. The catastrophic or lifetime protection. I don't like when people kind of fall into that average trap, if you will, and I'll get more into that here in just a moment. Joint coverage, our second to die structure or contract the way we have it today. Qualified money. Many people don't understand, many advisors don't know that we can use qualified money to fund a great long-term care plan to cover that whole portfolio. We've got both life and annuity-based long-term care solutions, and I'll touch more on that here in just a minute as well. And then we're not new at this. We've got 30 plus years of experience. Actually sold our first asset care policy back in 1988, and our annuity care plan back in 1998 was our first one. So we've got lots of history and experience doing this. And then lastly, I want to look at some kind of, as we go through here, a couple case studies and that give some ideas on really why and how and what clients to look for. So first and foremost, catastrophic protection. So why do you do that? Well, let's ask ourselves really quickly, why do we buy insurance? Is it, car insurance? Is it for the windshield replacement, or is it for that total car crash? Moving forward here, for the house insurance, is it just that roof replacement, or is it for that total loss from a devastating fire or tree limbs falling on the house, whatever the case may be? And when we're talking long-term care, is it for just an average amount, 6 months to 6 years? Or do we really want to look at covering that severe cognitive impairment, which could last up to 20 years? And that's why I think it's very important for these lifetime or catastrophic planning. So to illustrate this point, I really wanted to show you this little dot matrix, if you will. I've taken out the indices on both sides here, but each one of those blue dots represented a long-term care event in amount of time and claim dollars and that sort of thing. So you can see they're kind of all over this map, if you will. But what a lot of advisors do is fall into the trap of, hey, I'll just plan for the average. And this is probably why an average is not the best way to plan for that. So let me just add in this nice little line here. That's the average. Between all of these little dots on this map, if you're only plotting for the average, and I'm going to say that the ones below the line would certainly have been covered by that average line there. Actually, only 9 of those dots are actually along that little red or orangish line. So those are the ones that exactly hit the average. But look at all those then above the line that were, outside of that average. So if you're doing average planning and only planning for the average need of care, you can see how many of these claims still have to dig into their retirement portfolio. And when you plan for the catastrophic need or our lifetime benefits, which is just something that we have and only we have here at One America in the asset-based world, here's kind of what happens. I like to just show this as well. Every single one of those claims is now covered with some sort of income stream because we have that true catastrophic planning in place and a lifetime stream of income for any long-term care events. So that's why I think it's very important. And just to kind of hit this point a little bit further, I just want to show you some of these long-term care longest claims that are out there. 3 top companies out there, and some of these could still be actually ongoing, but this is through December 31st of 2018. The largest claim there was a female with company 1 over $2.3 million, so 16 years, 6 months. The largest from company 2 over 19 years, 3 months. So those are well, obviously, over the average amount of claim. And then company 3, over $2 million, if you will. And again, some of these could still be ongoing. So if you're only planning for the average, are you really doing your clients a disservice? I would think so, because, obviously claims can last much longer than the average need of care. So I'll get more into that, but I think it really hits home when we talk about our joint coverage. We have a second to die contract, meaning we can have 2 different individuals on the same policy, and they will pay out, to both individuals if they're needing long-term care. If they don't need long-term care, then it will pay a death benefit on the second insured. And what's great with the joint coverage is now you add that catastrophic, that lifetime coverage, and it really becomes a very strong, solid plan for your clients when planning for long-term care events. So let me give you just a little bit of highlight around this one as well. I did compare some of our competitors in this market space. And I think if you're like me, when you see a graph come up like this and there's some dollars on there, you automatically assume premium dollars. And you're like, well, OneAmerica looks the most. But if you start at the top and look at basically what we're doing, the premium is the same for all of our competitors and us. It's a joint case, $150,000. And compared to our competitors out there, they don't have joint cases. So we had to do 2 individuals with $75,000 each, obviously making that $150,000 premium, if you will. But really what it boils down to is looking at, okay, what type of benefits are these plans going to pay? Well, the middle 2 columns there will show you exactly what they're going to pay out for both the male and the female on this particular case. And you can see we're over $5,500 per month for any long-term care expenses that would be available to them. Our next closest competitor there would probably be Pacific Life down there at the bottom, paying, 46 at least in the female, 44 at the male. But what really I like to highlight here is that last column, because all of theirs are planning for the average. And all they do is go up to that average amount of time, 6 years. We're providing more benefits and at a lifetime option so that they can never outlive any of these benefits. They'll be available for both of them that they cannot outlive. And so I think that is just very important. And I really wanted to highlight some of this, some of the strengths of the plan that we have here at OneAmerica. So qualified money, I'm going to get into an example around this here in just a little bit, but just again, understand, because many people don't, that we have the ability to take qualified funds and put them into some of our asset-based solutions for your clients to really protect their overall portfolio. And why is that important? You look at the advent of the boomers here and really where these qualified sources, pre-tax dollar funding of their retirement started, really within that boomer period. And you see these 401ks, the 403bs, just individual IRAs, all growing tax deferred, thus making them obviously qualified money. But why not take a portion of those qualified funds and protect their whole portfolio? And again, many people don't realize that is an option out there, but we do have it here at One America. And if you look at the qualified funds and how quickly they are now growing over the past, 20, 30 years, we can see just how big this qualified money source is. So why not tap into some of that qualified funds? And again, I'll get into an example here in just a little bit around that. And then I also mentioned this earlier. We have both life and annuity-based long-term care solutions with One America. And I'll touch more on that as well. But the life is basically, it's a base policy. It's a life policy, single premium, recurring premiums, qualified funds, as I said. So we've got a number of ways that we can fund the plan, and then you actually fund what we call the continuation of benefits rider as well, which would create that lifetime benefit structure or that true catastrophic planning. Then we also have an annuity-based as well. So again, a base policy, which is based on an annuity. And I'm going to touch on really three main reasons why people look at our annuity-based solutions when I get into that a little bit as well. But I'll touch on one, really two almost in this little point when I'm talking about the annuity side. There's three main reasons that people will look at our annuity-based solutions. One could be underwriting. And as you can see here from the American Association of Long-Term Care Insurance, when we start to get the advanced ages, you're going to see a lot more inference of declines. So the last thing you want to do is talk to your clients about this, submit an application, and then get them declined. That leaves a sour taste in everybody's mouth. And so when we move to our annuity solutions, what we can do, even for those that maybe failed to plan, or looking maybe to add some more to their plan, we're going to see a lot less in terms of declines, because our underwriting scenario on our annuity-based solutions, annuity care, we see typically around a 95% approval rating. And the only reason there's a little bit of a 5% difference there is there's 5 knockout questions. So pretty simple there. If they do add the continuation of benefits rider, which could give them that lifetime coverage, there is a telephone interview as well. So if there's any kind of cognitive solutions, that's where that kind of possible decline, that 5% area may come into play. But again, if they failed to plan or want to add to a plan, they're getting advanced in age, annuity solutions are great. And then, the underwriting on these really helps as well. So that's why we have the two. And I'll get into an example around this a little bit later. I talked about this already, 30 plus years of experience. Again, 88 for asset care, 98 for annuity care. So we've been at this a long, long time. We've got a lot of great experience in pricing with these solutions. One of the best things about asset-based long-term care, certainly compared to traditional offerings, is the fact that people, you probably heard of some of the rate increase action that has happened on the traditional model, and these are asset-based, and so they are guaranteed premiums, guaranteed benefits, and a guaranteed death benefit as well. So all guarantees built into this. So getting into a little bit more in the weeds here and really kind of explaining what these concepts all are, many of your clients may have told you, you know what, I'm fine, I'll just self-fund any LTC risk that comes up. And I want to just show you, here's what the concept of self-funding then looks like. Again, you've got a very well-balanced portfolio here by this pie chart. Your conservative funds, your moderate, your aggressive for growth, moderate, certainly for growth, but certainly a little bit of downside risk there, not as much as the aggressive. But then your conservative funds, which are poised to preserve capital and many times with guarantees and that sort of thing. So if they're going to self-fund, here's typically what happens. When they have a long-term care event and $80,000, I'll use a fairly, standard or maybe even lower. If you get to middle America here, if you push it out to the coast, an average year of care is going to be much higher than this 80,000. So I'm using a very conservative number or Midwest type number of 80,000. Draining that, they're going to probably take that from the the conservation, the saving, the principal there, taking it out of the conservative funds. So they pull that out for any long-term care need, but that's just for 1 year. Now, what happens when they continue year after year needing that? And you can see how quickly that can invade somebody's portfolio. Now, their portfolio might be much larger than this, and it may not eat up that quickly, but essentially the concept is still there. It's exactly the same. They're just going to keep eating into that whole plan by self-funding. And there's just a better way of doing it. And that's where the concept of life-based LTC, or asset-based long-term care, comes into play. So why not peel out a portion of their conservative funds, again, looking for those guarantees. And so in this particular case, I'm gonna say it's for a husband and wife. So if 1 year of care was $80,000, I'm gonna take that for two of them. I'm actually gonna pull out less than 1 year of care for both of them, so 150,000 here. And what does that do? We can then leverage that to create a death benefit. So it's a life-based plan, so we create a death benefit with that single premium here. That death benefit now is what we use to accelerate the benefits if they needed for long-term care, but it's still their death benefit there. The death benefit would get used up first, so that's where their the long-term care benefits come into play. But if they never need it, and on the second to die in these contracts, then that death benefit gets passed on to their heirs. So there's nothing really at risk here, because it's still their money. They have access to it at any time. They create the leverage that is needed. They also get a guaranteed death benefit, guaranteed long-term care benefits if they needed. And then if we add that continuation of benefits rider, true catastrophic planning, we can create those long-term care benefits all the way through the second life that they can never outlive. So a much better way of really protecting that portfolio, if you will, than self-funding. So let's talk about the solutions. I talked about both life insurance, which we call our asset care, our annuity base, which is our annuity care. Here's kind of the suite of products, if you will. The ones that are kind of in that orangish kind of color there are some examples that I'm going to be going through today. But really, just know this: when you're speaking with your marketing partner there at IMES, or if you want to reach out to my internal, which I'll give his information here a little bit later as well, just give us the situation for your clients. We need a few things, and I'll talk about that here in just a little bit. But we can create these great solutions for you to present to your clients. So this is kind of the suite of products here, or solutions, if you will. But I'm not going to go into each and every one. We just don't have the time today. But I want to give you a good look at all of these options, certainly the ones that I'm highlighting there in the orangish red color. So with all of those solutions, look, One America is a blessing and a curse. And we've tried to simplify our solution offering set to make it easier to understand, because when you've got a lot of ways that you can create these plans, you've got a lot of options. And from somebody who's newer to long-term care planning, or is used to another form of long-term care planning, this may look a little foreign to them. And then when you've got a lot of options, it can be somewhat daunting or overwhelming. So we're really trying to just boil this down, simplify it, make it as easy to understand as possible. So I'm going to start with our asset care here. And again, let's simplify this thing. And we're going to talk about two things. We're going to talk about a base policy. And in our asset care, it happens to be a life policy that we're going to start with the base. That's going to be used for the long-term care need. So the base policy there, and then you've got the COB rider, continuation of benefits rider, which can either be for a portion to match the base policy, or where we really shine is that continuation or that catastrophic coverage of lifetime benefits. So pretty simple, base and rider. So let's go into a quick case study here. Single pay asset care case. We've got a recently retired couple, solid assets to cover their income needs. Thought self-funding was the way they were going to go until Mary's mom was diagnosed with Parkinson's disease. That was a little bit of an eye-opener. They own a CD worth $200,000. They considered that their emergency money, or you may have heard your client say, well, that's just kind of our safe money. We just leave that sitting over here. Well, that's exactly what Bill and Mary had. That their CD has now grown to $200,000, and that's their emergency funds. They would really use that for any long-term care. And I think you'll find this too. If you talk to your clients and they talk about these emergency money or these safe funds, or just in case, whatever they want to call it, when you ask them some follow-up questions on that, what they're typically going to be describing is a long-term care event. That's what they're using that money for. So why not leverage this? And let's show you ways that we can do so. So they had that emergency money. That was their plan. They were going to self-fund with that emergency fund. Now, Bill just got diagnosed with diabetes. The good news is he's controlling with diet and exercise. That was certainly a wake-up call for both of them. And so we're trying to put a great plan of care in place for them. So what we're going to do is we won't even take that whole 200,000 CD that they have, but we're going to reposition 150,000 of it. And we're going to create a plan for both of them. And that 150,000 then is split between our kind of timeline, if you will, there between the base policy and then the lifetime rider. So 150,000 single premium here creates a nearly $185,000 death benefit. We're going to accelerate that at 3%, which would give them over $5,500 per month for 33 months out of the base policy. But the other portion of that premium will also go to fund the unlimited or the lifetime rider as well. So that would continue that over $5,500 of long-term care benefits for the life, something they could never outlive. They'll never, again, if you remember that dot matrix, all of those would be covered because they've got this unlimited coverage. So that's kind of how that works, if you will. So I also wanted to go into more of a recurring premium. That was a single premium type situation. Now let's go into recurring premiums. Many people don't understand that we have recurring premiums as well. So we can treat it maybe more like a traditional long-term care plan. So same portfolio, same well-balanced, but now we're going to take, again, out of the conservative funds, certain portions to pay on a recurring basis. That creates the leverage for the death benefit. I didn't put an amount in there because it all depends on, ages, the amount of acceleration that they wanted to do, the long-term care benefits they're looking for. So the death benefit will change by a number of factors. So I didn't put an actual amount in there, but again, we're going to leverage the amount they give us for death benefit that's used for the long-term care benefits. And then we can always add that rider, which I will strongly, strongly recommend to cover them for life. So here's a quick example of that. We've got a young couple here now, male 52, female 51, started with a $4,100 monthly LTC benefit, and I added a 3% inflation for 20 years. Because they're younger, I feel that we still need to add some sort of inflation to make sure that this grows over time. And what I really tried to do here is keep it around a 500 if they're going to pay monthly. They weren't going to pay annually. So annually, we're talking $6,065 every year. If they're going to pay monthly, I always try and keep that around a $500 a month type plan. So that's where we come up with the 4,100. So we're going to start there, but we added that 3% inflation. We're going to create a death benefit here of $137,000 with that first premium that they give us on an annual or monthly basis. That creates that $4,100 for long-term care benefits for 33 months. They would use that first if they needed, those claim dollars for long-term care. And then part of that premium then funds the unlimited lifetime option. But remember, we added that 3% inflation for 20 years. So that $4,100 LTC benefit when we started this plan will grow by 3% each year for 20 years. So at the end of 20 years, we're going to be up to over 7,400 per person per month. And again, they can't outlive that amount of long-term care need. So great little example here too. I just wanted to kind of show you that recurring premium option. Now, the one that gets a little more in depth is when we talk about our qualified dollars option. And so because there's a little bit more to it, I've got a slide here. It's a little bit busy. I apologize, but I really like this option, and I wanted to make sure we could try and explain it as much as possible so you had a good grasp of it. So it is called our annuity funded whole life. I don't like the name myself because I think when people hear it, they think it's an annuity-based chassis, if you will, but it's really still our whole life chassis. It's just our qualified money option. I wish we would just kind of call it that, but I didn't name it, so we'll leave it at that. But here's a case where we're just going to take, a transfer of their qualified dollars and create this whole life asset-based long-term care plan for them. So here's your funding options: 401ks, 403bs, any existing IRAs out there. So in this particular case, Bill and Mary, both age 60, they had an old IRA out there. Some of you may have worked for a number of companies and just left an IRA that was just kind of growing there, or a 401k with an old employer, or whatever it is. They had a $250,000 old IRA. What we do is a trustee to trustee transfer. We take it from their trustee, wherever that those funds are at, that qualified source, transfer it over to our qualified annuity at OneAmerica, and do a very seamless, easy one application process from there. So we take that $250,000, we're going to automatically give it a 20% bonus. So any amount that they give us for this qualified option, we're going to give it that 20% bonus. And there's a number of reasons for that, and I'll get into that as we go through this particular situation. So they gave us $250,000, we give it the bonus. Now we've got a $300,000 pool, if you will, of premium dollars to create this whole life example. Now, I put this hourglass up here because I think that this really represents the best way, at least visually, to understand what we're doing here. So now we've got this qualified annuity here at OneAmerica, and we're going to siphon over the next 10 years out of that qualified annuity into the whole life policy. We take 10 equal distributions. So it's $300,000. So each year we're going to take $30,000 from that qualified annuity and fund the whole life asset-based long-term care plan. Now, because these were qualified dollars, still have to pay the piper sometime. IRS wants their money, needs their money. And but the nice thing is we're not taking that full $250,000 tax hit in 1 year. We're spreading that risk out over 10 years. So when we pull that $30,000, there is going to generate a LTC 1099 to your clients. The good news with this as well, these distributions can count towards RMDs. So just think of that as well. Now, you can see where that $30,000 then comes to split out over our timeline again, the base policy and the rider. So $15,000 of that $30,000 each year will go to cover the base policy and the death benefit there. We're creating nearly $300,000. And then the other portion of that $30,000 is going to the COB portion. Now, the good news with this, you can see exactly what that death benefit will afford them, nearly $9,000 per month each. So if they're both on claim at the same time, we're talking, 18, nearly $18,000 per month for long-term care needs. So again, and they can never outlive it because we have this unlimited COB rider added on there as well. So again, so each year we're just going to take those equal distributions for 10 years to fund that life insurance policy, and then it is done. Now, one thing that I will say, we have a waiver of premium built in on these riders. So let's say that one of the, Bill or Mary happened to go on claim, say in year 6, waiver kicks in for that. Those distributions out of that, the qualified annuity still pay out, will go directly to them, so they can use those extra funds for that, because now the waivers kicked in for the base policy. So this is a really, really nice option, if you will, funding source for our asset care solutions. And I just really wanted to hit on it. I know it's a little bit more information, a lot of busyness maybe on this slide, but really wanted to hit that piece home. Now, I want to go into the annuity side. Talked about our asset care side. Now I want to switch gears, go over to the annuity side. I told you there were 3 real reasons. The first 2 I mentioned earlier were age, maybe lack of planning, or underwriting ease. And one of the nice things about having both the life and the annuity options or solutions on the portfolio that we have, let's say we start on the asset care side, and unfortunately, because of the health history or whatever the case may be, they don't qualify there. We're automatically going to look and see, can we offer them an annuity solution? So we've got the pivot ability there as well, since we've got this annuity chassis also. But there's a huge reason that we look at the annuity cares as well, and it's really the ways to go from tax deferred to tax free income, and that's utilizing the Pension Protection Act, and I'll get into that here in just a little bit. But again, to simplify this, our annuity care solutions, just like asset care, we've got our base policy, and then you've got the ability to add that COB rider. So very quickly, wanted to talk about that. But let's get into the Pension Protection Act. Hopefully you remember what this was all about. But one of the biggest things the IRS did for us is created this portion of the Pension Protection Act, which says we can use these taxable gains in non-qualified contracts that are out there, non-qualified annuities, 1035 exchange into a HIPAA compliant PPA eligible annuity, like we have all of ours at One America, and use any of that gain and basis all tax free. So basically what we do here, instead of having all the gain come out first and being taxed to that client, why not leverage that, use the 1035, put it into our annuity care solutions, which are all HIPAA compliant and PPA eligible annuities, and then any of those resources that they use for long-term care expenses are all going to be income tax free. Can also add that optional continuation of benefits rider, which I talked about as well. So this is the other big portion of why we look at our annuity solutions. And I think that this is really a no-brainer. If you, again, look at your clients, look at your book of business, many of them may have some non-qualified annuities just kind of sitting out there outside of surrender charges, not really growing much anymore because the interest rate environment is so bad, but they have pretty sizable gains that are sitting out there. Now, if they just left those where they're at and started to tap into those for any long-term care benefits, they're going to be taxed on certainly the gain first. Why not just 1035 that into our annuity care solution, one of the solutions, and now if they have any long-term care expenses, they're all going to be tax-free income. So great way to get rid of some of that taxable gain for income-free resources when it comes to long-term care expenses. So I really like that there's really no downside for your clients when you look at that situation. It's still their annuities, still their money. And at some point, if they don't have any long-term care needs, it still passes on to their heirs just the way it would the annuity that's just kind of sitting out there. So great reason to look at our annuity care suite of solutions as well. So I'm going to give you a quick case study here on one of our annuity care options, which we call Annuity Care 2. But here's Marie, sweet Marie, age 72 here. She's retired, solid assets, a pension to cover her income needs, so she's good there. But she's concerned that LTC expenses would jeopardize any, legacy that she wanted to leave to her kids. So being over the age of 70, and certainly in the time of COVID that we're still in, hopefully we'll get out of here, within the next three to 6 months with all the vaccinations, but that really prevents her from the purchase of any traditional or even hybrid long-term care insurance out there. Being over the age of 70, many times has precluded her. There's so many restrictions out there around, applications because of a certain age. Well, on our Annuity Care 2 or Annuity Care Solutions, we don't have any of these restrictions. She owns a non-qualified annuity worth $200,000, $100,000 a base, $100,000 a gain. It's at a guaranteed interest rate of 2.5%, which is quite good right now. So we're going to use that, and that was what she was going to use for any long-term care expenses, but without any coverage, that was really where she was going to tap into. But again, if she taps into that non-qualified source, it's a taxable annuity, and that's where she starts paying, obviously, any taxes on the gain first. It could push her into a higher tax bracket. It could affect her Medicare premiums. There's a lot of things that could really impact your clients if they just leave it there versus moving it, 1035ing it over to a PPA eligible annuity. So here's your action: self-funding, doing nothing, status quo, leave it where it's at. $200,000 non-qualified annuity. Outcome: when she starts taking withdrawals from that for home care, what happens? It's not the full $200,000 that she's going to get. It's going to be, taxed on any of that gain, and it could be only $175,000, and that's a fairly conservative, tax rate there. But she doesn't get the full $200,000. If we leverage it for long-term care, so changing assets for changing needs, obviously we're going to leverage that. We just take a 1035 exchange from her existing non-qualified annuity, put it into our Annuity Care Solutions, which are PPA annuities. Now that $200,000 pays for both the base and COB charges, internal charges, to cover any of her expenses. Really what this Annuity Care 2 does, this is the only annuity care plan which we don't have lifetime benefits, but we heavily leverage that funding source. So really that $200,000 becomes $500,000 in tax-free long-term care benefits. So what a great